If you're looking for high dividend paying stocks at low prices, penny stocks are definitely a good option to consider. While they do have the potential to be riskier, many of these stocks can pay such high dividends that reinvesting them can really create a massive snowball effect that I'll discuss more of later in this video. I know when it comes to deciding which stocks qualify as penny stocks, people have different opinions as far as what the price limit should be. I know some people think that only stocks with a share price of $1 or less should be considered a penny stock, while other people consider $5 or less to be a penny stock, and then there's some people who would consider $10 or less to be a penny stock. I first started my research by looking for stocks that were priced at $1 or less, but I wasn't too impressed with what I came across. Most of these stocks priced less than $1 rarely offer dividend yields greater than about 1 or 2%, which I believe really aren't worth it in terms of dividend investing. Additionally, most penny stocks don't pay shareholders dividends at all because they're more concerned about growing the company by reinvesting those earnings instead of passing them on to shareholders. When I broadened my search results to include stocks priced up to $5 or less, that's when I began to find companies that were offering much higher and sometimes growing dividends. The vast majority of these companies paying high dividends, though, are the types of companies that are required to. So for example, companies like REITs, BDCs, and MLPs, which are required to pass on a certain percentage of their earnings to investors, make up every stock on this list. So in this video, I'm going to be presenting stocks for your consideration that are currently priced at less than $5 per share that currently offer investors high dividend yields. While again, these stocks are considered riskier than others, for this list I also wanted to avoid penny stocks that have seen significant difficulties or massive price drops in their share price over a long period of time. For example, Great Elm Capital Corporation is significantly cheap and offers a massive dividend yield, but the company as a whole has seen its fair share of struggles, which has reflected that fact in its share price. They also switched from monthly to quarterly dividends and slashed it pretty significantly. I'm not saying it's impossible for them to turn things around, I just chose to pick penny stocks that have had better track records. So with that being said, let's get into it. The first company we're going to take a look at is Sachem Capital Corporation, ticker symbol SACH. Sachem operates as a real estate finance company that's involved in the originating, underwriting, funding, and managing of a portfolio of short-term bonds. They offer loans to real estate investors to fund their acquisition, renovation, and development of residential or commercial properties primarily in the state of Connecticut. Sachem Capital is a mortgage real estate investment trust, which is a sector that was significantly impacted by the pandemic back in March of 2020. Many of the big players in the mREIT space, like Annaly Capital Management and New Residential Investment Corporation, reported huge losses for the year 2020, and their share prices reflect how hard hit these companies were. But Sachem Capital isn't like other mortgage REITs out there. According to their income statement, they not only reported positive income, but actually saw an increase in net income by 45% from the previous year. So what could explain this significant boost in income for 2020? I think the best explanation for this increase would have to be the housing market right now. Sachem provides loans to people who fix and flip houses as well as purchase them for investment purposes. Unless you've been living under a rock or you're simply outside the US, the housing market has been booming this year with a lot of people wanting to relocate or simply move into their own home away from the crowded cities because of the pandemic. And while there is talk that the boom is coming to an end, we'll have to wait and see how Sachem will continue to perform in the future. Their stock currently offers investors an impressive 9.68% and pays a quarterly dividend of 12 cents per share. They've continued to experience year-over-year growth in their revenue, which definitely helps in terms of paying these high dividends. Their share price also recovered pretty quickly from the plunge back in March of 2020, while some other mREITs like New Residential continue to have a difficult time recovering. This next stock we're going to take a look at is Lument Finance Trust, ticker symbol LFT. This is another mREIT that focuses on investing, financing, and managing a portfolio of commercial real estate debt investments in the United States. The company invests in commercial mortgage-backed securities, fixed-rate loans, construction loans, and other commercial real estate debt instruments. They were founded back in 2012 as Hunt Companies Finance Trust before changing their name in 2020. This stock share price has fully recovered since March of 2020 and has even increased by 21% from its pre-pandemic price. It currently pays a dividend of 9 cents per share, giving them a dividend yield of 8.85%. It's also worth noting that they also increased their dividend slightly from 1 year ago, which is something that a lot of other mREITs couldn't achieve. Lument was another rarity in the mREIT space that performed much better than other companies during that time. Much like Sachem, they also reported positive revenue for the year 2020, and they currently project year-over-year growth for the year 2021 and even going into 2022. I think the main reason for this recent success has to do with how the company's been revamping itself. They didn't just change their company name, but they also adopted new strategies as well as new management behind the company. Lument, or back then Hunt Companies Finance Trust, acquired Five Oaks Investment Corporation, which was a failing REIT at the time back in 2018. After new management came in, they adjusted their strategy and they now focus on multifamily and commercial debt instruments. So far, this new strategy appears to be working for them. Looking at the long-term performance of this stock, back in 2018 when they acquired Five Oaks, their share price was around the $3 mark, whereas today it's grown to $4.11 per share. Their share price has also increased by over 67% in the last year, so we'll definitely have to wait and see how things play out for Lument going into the future. Next we have VOC Energy Trust, ticker symbol VOC. This company acquires and holds a term net profit interest of the net proceeds from production and sale of the interest in oil and natural gas properties in the states of Kansas and Texas. Their underlying properties had interests in 470.3 net producing wells and 84,332 net acres, and had proved reserves of approximately 3.1 million barrels of oil equivalent in Kansas. You probably noticed that according to Yahoo Finance that this stock pays a 15.72% dividend yield, which is pretty incredible, but there's a really important detail to keep in mind. VOC Energy is what's known as a royalty trust, which is a type of dividend investment I haven't really talked about on my channel. Royalty trusts and master limited partnerships do have some similarities, but there's one key difference between the two. Both types of companies pay massive amounts of dividends to shareholders, but the dividends received from royalty trusts are much more unpredictable. MLPs can potentially sustain and grow their dividends over a long period of time, but the dividends received from royalty trusts are extremely dependent on oil and gas prices. Just by taking a quick look at VOC's dividend history over the last several years, we can see that no two quarters were exactly the same. One quarter paid 20 cents per share, while another paid only 3 cents per share. So if you're retired and looking for consistent income every month or every quarter, royalty trusts probably aren't going to be in your best interest for that. Despite that though, the share price of VOC has increased 128% in the last year, and it's been hovering between $3 and $5 for the last 6 or so years. With those reinvested dividends, if you would have invested $10,000 into VOC 5 years ago, you'd now have nearly $22,000. But again, that depends heavily on oil and gas prices going forward. Before I continue, if this video has provided you with any sort of benefit, I'd really appreciate it if you could give it a thumbs up, and also feel free to subscribe if you want to see more content similar to this. Thank you all so much for your consideration. Now we have Oxford Square Capital, ticker symbol OXSQ. This is a business development company that operates as a closed-end, non-diversified management investment company. Oxford invests in both public and private companies and invests in secured and unsecured senior debt, subordinated debt, preferred stock, common stock, and syndicated bank loans. Oxford is the oldest company on this list, having been found back in 2003. They managed to survive both the 2008 financial crisis as well as the pandemic. Their stock currently offers an 8.94% dividend yield and pays a monthly dividend of 4 cents per share. Oxford has continued to recover from the plunge back in March of 2020, and right now their stock is up 63% from this time a year ago. I've talked about this company a couple times before on this channel. What they do is they invest primarily in corporate debt securities and collateralized loan obligations, or CLOs. If you go to their website, you can check out their investment portfolio, which shows a total portfolio of $404.8 million. It says their top 10 portfolio investments by fair value represent approximately 43.8% of their total portfolio, which is pretty sizable compared to other business development companies I've seen. Their investment portfolio in terms of which industries they invest in is also less diversified than companies like Ares and Main Street Capital. Despite that though, while this company has taken a hit during the pandemic, if you'd invest $10,000 into Oxford 10 years ago with dividends reinvested, you would have seen a total return of over 108% according to Dividend Channel. I definitely consider this company to be higher risk than others, but again, as you can see, investing in Oxford has still been very profitable over the long term so far. If you guys happen to have any dividend-paying penny stocks you like that I didn't cover, feel free to leave a comment below, and also feel free to share your thoughts on these 4 stocks. Do you hold any of them, or are you avoiding them for other options? I'd be interested to know all of your opinions on these. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching, and I'll catch you next time. Take care.